Well, hello there. I'm Gemini. That battery can last up to 24 hours even with the always-on display turned on. It's pretty cool. Hello and welcome. If you're running your own business as a sole proprietor or in a partnership, you know taxes are just a fact of life. But what if I told you there are smart, completely legal ways to lower that tax bill, maybe even significantly? Well, in this explainer, we're going to dive into the key strategies that can help you keep more of your hard-earned money right where it belongs, in your pocket. So here's our game plan. We're going to build your tax-saving toolkit from the ground up. First, we'll get a handle on your basic tax reality. Then, we'll jump into the everyday deductions that so many people miss. After that, we'll look at the incredible synergy between your personal and business finances and then some of the bigger strategic moves for long-term planning. And finally, we'll wrap it all up with a clear action plan. So, let's get into it.
Okay, first things first, your tax reality. Before we can even talk about saving a dime, you have to understand this one core concept. Honestly, everything else we discussed today is built right on top of this foundation.
Now, this is absolutely crucial to grasp. As a sole proprietor, your business doesn't file its own separate tax return. It's not a separate entity. Instead, all of your business profit or loss flows directly onto your personal tax return, and it gets taxed at your personal marginal tax rate. That means every single dollar you spend on a legitimate business expense directly lowers your personal taxable income. It's a really powerful one-to-one connection.
All right, with that foundation in place, let's get into the fun stuff. Section 2 is all about everyday business deductions. This is where we focus on capturing all those small wins that, trust me, add up to huge savings by the end of the year.
We're going to zero in on 3 key areas here. First, the incredibly simple but vital habit of tracking every single receipt. Second, the home office deduction, which is so often overlooked. And third, how to properly maximize your vehicle expenses. You know, it always surprises me how many business owners let this slide. That $3 parking meter, that $10 pack of pens, it all feels so small, right? But just think about it. If you have just $20 a day in these little expenses, that's over $5,000 in deductions in a year. If you're in a 30% tax bracket, that is literally $1,500 back in your bank account. So the big takeaway here? Get a system. I don't care if it's an app, a spreadsheet, or just an old shoebox, capture everything. Okay, now let's talk about where you work. For so many of us, especially in the beginning, the line between our home and our office is, well, it's pretty blurry. The good news is the tax system gets this, and it offers a really powerful deduction if you qualify. So, if you have a space in your home that is dedicated and used exclusively as your main place of business, you can deduct a portion of your major household bills. The math is pretty simple. If your office takes up, say, 10% of your home's total square footage, you can deduct 10% of your utilities, your home insurance, property taxes, even your mortgage interest. You're basically turning personal expenses into legitimate business deductions. It's fantastic. And just like with your home office, if you're using another personal asset, your car, for business purposes, you are absolutely entitled to deduct a portion of its operating costs. But, and this is a big but, you've got to have proof.
What you're looking at here is exactly what the tax authorities need to see. A detailed, up-to-date mileage log is completely non-negotiable. You write down your car's odometer reading on January 1st, and then you log every single business trip, the date, the purpose, the kilometers driven. At the end of the year, you figure out what percentage of your total driving was for business. That percentage is then applied to all your vehicle costs, your gas, insurance, maintenance, you name it, and that becomes your deduction.
Now please, pay very close attention to this one. Just handing over a credit card statement that shows you spent money at a gas station is not good enough. They can argue you were just buying coffee and snacks. You must keep the actual machine-printed receipt from the gas pump that shows the details of the fuel purchase. This is the kind of detail that makes your deductions hold up under scrutiny. Okay, moving on to Section 3. Here, we're going to zoom out a little bit from pure business expenses. We're going to look at how your personal financial planning can create some really powerful tax savings that bridge both of your financial worlds. The Registered Retirement Savings Plan, or RSSP, is just one of the best tools you have. Remember how we said your business income is your personal income? Well, every single dollar you put into an RSSP is a dollar you can deduct right off the top of that income. So you're lowering your tax bill for this year, while at the same time, you're building up your retirement savings for the future. It's a true win-win situation. Even your charitable giving can be strategic. The tax system definitely rewards generosity, but it rewards consolidated generosity even more. As you can see, the tax credit you get is at one rate for the first $200 you donate, but it jumps to a higher rate for any amount above that. So instead of making a bunch of small, separate donations throughout the year, think about bundling them together to push you over that $200 mark and maximize your total credit.
All right, let's talk about the big picture now. We're moving into some major financial levers. These are the kinds of strategies that can have a massive impact on your taxes over the long run, especially as your business grows and changes.
Look, especially in the early days of a business, it's pretty common for your expenses to be higher than your income. This creates something called a non-capital loss. Now, a lot of people just see this as a bad year, but from a tax point of view, that loss is actually a really valuable asset if you know how to use it.
And this is what's so amazing, the flexibility you have with that asset. You've got choices. You can carry that loss back up to 3 years to apply it against past income and get a refund on taxes you've already paid. You can use it in the current year to wipe out any other income you might have. Or you can carry it forward for up to 20 years to lower your taxes in future, more profitable years. It's an incredibly powerful tool for long-term planning. This brings us to a huge strategic question that almost every successful sole proprietor asks eventually: when should I incorporate? And the simplest answer is right here on the screen. It's time to seriously consider it when your business is consistently making more money than you need to take out for your personal living expenses.
And this chart shows you exactly why that moment is so critical. As a sole proprietor, every dollar of profit is taxed at your high personal marginal rate, but an incorporated small business gets to pay a much, much lower corporate tax rate, at least on its first chunk of profit. That huge gap between those two bars, that is a massive opportunity for tax deferral.
So let's just walk through how this works, step by step. 1, your business makes a profit. 2, the corporation pays tax, but at that nice, low, small business rate. 3, the money that you don't need to live on is left inside the company. This is the key. You are deferring the personal tax you would have paid, which leaves more capital inside the business to reinvest, to hire, to buy equipment, and to grow faster. It's a total game changer.
Wow. Okay, we have covered a ton of ground, from tiny daily habits to huge structural decisions. So now, let's bring it all home and turn this information into your personal action plan.
So let's just quickly recap the key takeaways. Number 1, track everything. No expense is too small to matter. 2, maximize your home office and vehicle deductions, but do it with solid documentation. 3, make your personal savings and charitable giving work for your tax plan. 4, understand that a business loss isn't a failure, it's a strategic asset. And finally, number 5, keep an eye on that tipping point where incorporation becomes the smart move for your business.
So I'll leave you with this final thought. All this knowledge is only powerful if you actually apply it. So take another look at this list and just decide which one of these strategies are you going to dig into for your business, starting this week. Making that choice and taking that first step is how you start to truly optimize your tax situation.